When it's time for you to be mandated to take money out of your IRAs, what are you going to do with the money if you do not need it? Well, that's what we're going to be talking about in our Tuesday tips, so stay locked in. My name is Carson Graves, certified financial planner and president and CEO of the Retirement Education Center, and I want to welcome you once again to our Tuesday tips, where we're going to be talking about what to do with the unwanted money from your required minimum distributions that you have to take when you reach the age of 73 from your IRAs. Now, I can tell you that anytime we're talking about required minimum distributions and money that you have to extract from funds that you may have deferred for a long time, many of my clients who have been comfortable not taking those dollars get very uneasy when it's their turn to now start taking money out of these accounts. Because these distributions can be rather large and it can cause a lot of things to be activated. You could end up having to pay more taxes on your Social Security benefits. It can push you into a higher tax bracket to where you may now have to experience maybe a surcharge on your Part B or Part D premiums for Medicare. So when you enter the age of having to take these distributions and you do not need them, there are things that you might want to think about that you can do with these distributions that can be to your advantage. And that's what we're going to be talking about today in our Tuesday tip. So let's go ahead and jump into our lesson today. So first we need to understand, what are required minimum distributions? Well, basically all they are minimum amounts of dollars that you must pull out of your retirement accounts each year from like a traditional IRA, maybe a SEP IRA, simple IRAs, and even old retirement plan accounts once you reach the age of 73. Understand, when you do take these withdrawals, you are going to be taxed on these withdrawals at your ordinary income tax bracket. Mandatory withdrawals must begin no later than April 1st of the year that you turn 73. So for instance, if you turn 73 in 2024, by April 1st of 2025, you must have actually taken out the required minimum distributions for that year, because if not, the failure to take those required minimum distributions can come with a very hefty penalty of 25%. Now, I do believe that it's noteworthy for you to understand that any account holders who may have reached the age of 73, but they have a retirement work plan like a 401k or a profit sharing plan, you can still delay taking any required minimum distributions from those accounts if you're still working there, unless you are a 5% owner in that particular business. But if you're not a 5% owner in said business, you can delay taking any required minimum distributions from that 401k until you actually stop working for that company. I also think that it is noteworthy in this video to understand that any money in a Roth IRA is not required to have any distributions taken from them. So if you own any individual Roth IRAs, or if you have a Roth 401k, you do not have to take money out of those accounts. It is not mandatory. Only on traditional IRAs and qualified accounts are you mandated to take money out of those accounts when you get to your required minimum distribution age. Now, the other question that you may want to know is, how do they calculate your required minimum distributions? Well, it's pretty simple. One of the things that you must understand is that you have to calculate your RMDs on all of your IRAs and qualified retirement accounts. So if you have 4 IRAs, each of those individual IRAs must be calculated for their own required minimum distributions. So these distributions are calculated by taking the prior December 31st balance from that IRA, and they divide that into the IRS life expectancy factor. So for example, if you happen to have turned 73 in 2024, and now you are required to take required minimum distributions, but you have an IRA balance of $300,000, how they're going to calculate this is that they're going to look at your December 31st, 2023 IRA balance. And let's just say it was $350,000, and the IRS single life expectancy factor is 16.4 at this particular moment. Well, all they're going to do is take the $350,000, divide that by 16.4, and you would be required to take out $21,341.46 for 2024 RMDs. Now, as you can see, that is a lot of money. So the question now is what this video is about. What will you do with this money if you happen to just not need it? Well, I want to point out 5 things that you possibly could do with these dollars if you happen to not need them. One, you could decide to be very generous to your family at this point. You didn't need the requirement of distributions to live on, so you can gift this money and not have to pay a gift tax up to $18,000 in 2024. So you can give some of this money away. You could also, if you're charitable, give money to a charity up to $100,000 and not even have to pay any taxes on that distribution from the IRA. These are known as qualified charitable distributions. So if you desire to give money to a charity and you want to take those RMDs that you do not need and give it to that charity, well, you can do so in a tax-free manner by doing a qualified charitable distribution. You could also take these distributions and fund a 529 for your grandchildren. So if you had an ideal of helping your grandkids, fund their college education, or your own kids if they're still needing to go back to school, you could take those funds and fund a 529 plan for the grandkids. And most importantly, you can reinvest these dollars. Because the IRS is making you take these dollars and they're taxing you on it, well, you can also put it back to the IRS and say, you know what? I'm not just going to let this money sit and rot in my checking account. I'm going to go ahead and reinvest these dollars. Maybe you can fund some dollars for a long-term care situation in the future. You're 73. Most people do not experience long-term care incidents until they're early to maybe mid-80s. So just imagine if you had 10 years of taking this $21,341 and just putting it away into a brokerage account. And let's just say the money that you were putting away for that 10 years was growing at 7% per year. Now, you might be thinking that's pretty aggressive, Carson. I mean, to grow that money at 7%, I'm 73. I don't know if I want to be that exposed to the marketplace. But you have to remember, you do not need or want this money anyway. So you're trying to just put this money away for the betterment of yourself or your family, perhaps. So with that being said, after 10 years, at growing at 7% per year, as you can see, that money would have grown to over $294,000. Now, you can use that for your extended care if need be, or that could be left to your estate also. And the last thing that I would recommend that you can do with this money if you just do not need it, go and spend it. Don't just let it sit in your savings account. If you always wanted to travel or you wanted to buy that lake house, or if there was anything that you wanted to do, but because you were always afraid that if you spent that money, you would run out of it, and now that the IRS is making you take it, go ahead and live a little. Take that money and do something that you love to do and enjoy your life. Thank you for tuning in to our Tuesday tips. Please understand that these videos are created for educational purposes only, and that you should always seek out your own financial advisor, your own tax advisor, and your own attorney regarding your personal situation. Also, if you are looking for an independent fiduciary advisor to help you with these types of complex financial matters, we highly recommend that you utilize the links in our description below and go ahead and schedule a 1-hour free consultation with us today. And we would also like to hear from you. Let us know what you decided to do with your required minimum distributions in the comment section below. Did you decide to spend that money, or did you decide to do something charitable, or did you decide to just reinvest it? Let us know in the comment section below. And if you found this information to be beneficial, all that we ask is that you subscribe to our channel so it can continue to grow, like this video, and share with others.